Now let's move our focus to the fixed income market, and I'm joined from Diamond Bank trading floor by Emmanuel Odiaka. He's a bond dealer at Diamond Bank. Emmanuel, it's very good to have you on the show with us today. Now, of course, we know that there's a bond auction scheduled next week for the 17th, which is the same day that the NBS, which is, of course, the National Bureau of Statistics, would be releasing inflation figures for March. What are your expectations for yield outcomes at the auction, considering the impact that inflation figures could have on market sentiments?
Thank you for having me on the show. Basically, market will not be expecting any much deviation from inflation figures when compared to February numbers. Basically, inflation may still trend between 9.3 to 9.6, and that won't make much impact on market. This is owing to base period effect that will keep inflation this low. However, luckily, market will be seeing these figures before auction on Wednesday, and will then price this accordingly into its auction details. The secondary market is trading presently at around 10.7 to 10.8% across the yield curve. We could see a slight firm up of yield on auction stop rates.
Now, of course, there was a bullish market last week, opening Tuesday after the Easter break. How has market fared going into a new auction week?
Thank you. Yes, market was quite bullish opening Tuesday last week, and that was owing to the listing of the federal government bond into Barclays Emerging Market Local Bond Index. Although market has factored in this information before now, but what we saw especially on Tuesday last week was highly speculative. There was a yield drive-in across maturities, and we saw market yield moving almost 50 basis points. That was massive. In Naira terms, we are talking about almost 3 Naira per maturity. And of course, the natural thing that you will see happen in this outcome is profit taking. So what we saw last week was highly speculative. And fortunately and unfortunately, as we may have it, there was a fixed special almost sales to market at a yield of 12.75. The other thing you would want to ask is, naturally, what would dealers do at such information that filtered into market?
Yes,
and our answer would be that there will be an asset or portfolio switching from short tenor treasury bills bond to the fixed income instrument, which was to offer an effective yield of up to 14.1%.
Speaking about this fixed special OMO, we've seen that happen now on 2 occasions. It will be interesting to know if you feel like we could have more of those bills, such bills being sold in the market.
Yes, the idea about the fixed special OMO, from what we hear from the Apex Bank, was to mop up the lingering liquidity in the system. Q1 already, we have seen the Apex Bank mop up as much as 4 trillion in OMO issuance, when compared to about 2 trillion that was mopped up from the system in Q4 last year. That's a massive leap in liquidity into the system. Going forward, well, today we saw them come with OMO, but there were no sales because of the impact at the interbank local currency market. We saw interbank rates go as much as 14%, and I think that informed them to cancel that offer to the market.
But, what's the impact on that?
Well, the impact going forward, like we have seen, was crisscrossed across the trading maturities. Trading maturities near to the tenor that was offered, we saw a yield spike on them by nearly 20 basis points. And on the bond market too, we saw a gradual sell down on bond instruments, and yields went up slightly today.
Now, of course, in the news, we had that the MBS will miss the GDP rebasing deadline, which of course was scheduled for Q4, and it's likely to be delayed. What implication could this have for the market?
Well, market has factored that in earlier in the year. I think the rebasing period has been postponed for a third consecutive time now. We now hear that could come up by probably first quarter next year. Generally, the impact of GDP on securities is that speculators and investors watch GDP closely because of its influence on monetary policies. If GDP were to remain sluggish, there would be a speculative tendency that the Apex Bank may have nothing to do with monetary easing. However, if they see a bloated GDP or GDP going up, that could call for inflationary trends, and that could tinker the Apex Bank to want to raise MPR. However, we do not see that happening anytime soon.